This is Barry Wines. I'm with Cherry Bekaert in Tampa here, and I'm going to get us started. I'm going to act as the host and moderator. So today our speakers are going to be Mike Kirkman. He sits in Charlotte. He's a partner and our national leader of estate, gift, and trust services. Steve Danner is a partner in our Coral Gables office in the private client tax services line. And Sam Saunders is in the Raleigh office. He's a manager in estate, gift, and trust services. So, Mike, I'll let you take it from here.
Thanks a lot, Barry. Excuse me. Welcome, everybody. We have an hour to go through some material, and I must caveat and say that there's no way we're going to be able to cover everything, but hopefully our goal is that when we finish the presentation that you'll have some ideas and maybe some things that you're thinking about or that you begin thinking about that we welcome you to reach out to us for further discussions on what's happening with the new Tax Cuts and Jobs Act. It was over 1,100 pages and it's a lot of material, but we're going to go through some basic things regarding the new tax law and then really try to focus in on some of the planning opportunities that are out there. So to begin with, just start real basic. I'm just going to illustrate two rate schedules here. There was all this talk about going to 4 rates and 3 and 5. Well, we ended up with the same 7 rates, but at different levels, which you can get a flavor of when they kick in. I think that the highlight here on the single and in the next slide here on married, filing joint is that we see that the 37 is now the new top bracket at a higher amount than under the previous thresholds. So you've got a 2.6% reduction at both the top level. And the rates, the brackets kick in at a little bit different times. Just getting a flavor of the bracket kick in at the top rate, you're really looking at these levels here, 500 and 600, married, filing joint, and single here. The cap gains rate stayed in place at 0, 15, and 20, and here's the trigger points of capital or taxable income of where those rates kick in under the new law. And by the way, these are indexed, these threshold breakpoints are indexed for inflation. You know, it seems like you can't turn on the TV and hear somebody talking about the standard deduction and the repeal of the exemptions. But everybody, if you're not familiar with our joint, married filing joint exemption or standard deduction being 24 and the single being 12, well, there it is. It sounds like they talk about it so much that it's the holy grail. But the personal exemptions have been repealed, and we do have a new inflation index amount. Or a criteria that's being applied, this chain CPI index. The only thing to take away from that essentially is that it's going to be a slower uptick on how certain, whether it's the standard deduction or certain other items are going to be increased over time. It's much slower increase. We say repealed, but actually these items are suspended through 2025, and unless there's new passage or permanency put in place, these will all revert back and become new law in 2026. But just to give you a flavor of some of these, the one takeaway that I tell people when they're looking at these various items here is just the variety of complexities that are made up within our tax system. Not that it's not complex now, but you can see these various threshold amounts that you have to hit to be able to deduct certain items. One of the highlights here is that the medical was extended through 2018, so it is in place for this year at a 7.5% of AGI limitation. But these other items, the miscellaneous itemized deductions, are gone. Moving expenses and reimbursements only apply to armed service members. And one that's floating around out there is the discussion about alimony. And alimony payments after 2018 for divorces or an agreement's not or put in place in 2018, post that, the deductibility and the income inclusion on alimony payments will no longer apply. Now, if agreements are tinkered with, there's some provisions that say if you have an existing agreement in place before this deadline and it gets changed or altered in certain ways, then the future deductibility or income pickup could be lost too. So you've got to be careful there. Two of the bigger itemized deduction changes that that's in the bill or in the new tax law relates to home mortgage deductions. There's a cap placed on acquisition indebtedness of $750. There was a bit of a grandfather of the $1 million limit if your property was purchased before December the 15th. And the one thing that I think is going to sneak up on a lot of folks is there's no deduction for home equity indebtedness. That's a pretty broad statement, and there's going to be some clarification of what true home and equity indebtedness, and if those funds are used for expansion of an existing home and things like that, there may be some exceptions. Under the SALT limitations, state and local taxes, that does not apply to trader businesses. So if you have a Schedule E where you're renting property and you've got real estate taxes there, there's going to be no limitation under that scenario. But when you talk about non-trader businesses, you're really focused in on itemized deductions. It's capped at $10,000. And of course, before 12/31/17, there was a lot of dialogue about, hey, we're going to prepay these real estate taxes or make some large payments for income taxes. The services position is that unless there is a viable debt at that time, it's not going to be allowed or deductible. Now, that being said, what I would encourage everybody to do is sort of pause a minute if you've already done that, but pause for a minute and wait, because there could be some challenges coming over the next several months about whether the service or the Treasury had the right to take their position that they did. An increase in the deduction percentage for charitable contributions on cash contributions moved from 50 to 60% of a donor's AGI. The 5-year carryover stayed in place. If you have tickets because of some donations that you make or purchasing of tickets for athletic events, in the past there used to be this 80% amount that was deductible related to the cost of those sports events. That is no longer in place, and there was some reporting requirement changes that came into play as well. I just want to highlight here on the 529 plans that they've been around for a while, but the one thing they threw in the final bill that became law was that elementary and high school expenses, if they were paid out of a 529 up to $10,000, are now acceptable and not considered the earnings on those monies within the 529 that come out for elementary and high school are not taxable. And it also has a provision in there for unborn children that can be named as designated beneficiaries. The one caution I would cause everybody before they start drawing out 529s for, say, private school, elementary school, whatever it may be, K through 12, is that you need to make sure that whatever state you're in, that you look to the state law, because some of those states may not provide or follow what the feds have done. So, and then it would become taxable. So I would just caution you before you make that distribution to look at the state, or maybe contact us and we can give you some guidance in on that. Some other individual changes, if anybody's prepared their tax return over the last 10 years, you're familiar probably with AMT. It has caught a lot of people over the last 15, 20 years, mainly because it wasn't indexed to inflation, the exemption amounts. The exemption amounts have went up severely under the new law, or significantly, so that should phase out a lot of middle taxpayers from being hit with AMT. And the kiddie tax, I won't go into this too much, but I will tell you as a practitioner, it was a very complicated calculation when you have multiple children and investment income that they had in their names through gifts or inheritance. Their kiddie tax gets a lot simpler. However, the rates that are going to apply to a kiddie tax computation are the rates that apply to an estate and trust, and as we go through those rates, I think you'll see that you hit the top rate in a kiddie tax scenario at a very, very low level of income. Some of the items that did not change, I will tell you that just to highlight the two that I think we see the most of is the capital gains from a personal residence sale. Those rules still stay in place. The $500,000 married filing joint exclusion on a gain of a personal residence. The other item that we were getting nervous on, and a lot of folks in the investment world were getting nervous, was the basis of stocks and mutual funds. And essentially, the service or the Congress was going to suggest that all sales of securities had to be based on a FIFO basis, first in, first out basis. So capturing a lot of the securities that had low basis as opposed to picking and choosing what particular block of stock that you're selling. That rule did not hit, thank goodness. And with that, I will turn it over to Sam Saunders.
Thanks, Mike. We can go over some of the changes that have occurred in the state and trust income tax world. Some may refer to this as fiduciary income tax. This is a comparison of the old rates and the new rates. They did consolidate down from 5 to 4 brackets. However, you'll notice that you're going to hit the top bracket at $12,500. It's a very compressed tax bracket, so most trusts you hit that top level pretty quickly, depending on the amount of assets in there. Now, where the personal exemption has been repealed, in lieu of that, they did keep a deduction where an estate receives $600 deduction, a simple trust receives a $300 deduction, and a complex trust receives a $100 deduction. These are the same as the exemptions were prior to the tax reform. As we discussed, you hit that top rate at a very high number, and there's also some unanswered questions related to deductions and what deductions are still going to be allowed. It appears that we will have a $10,000 state and local tax deduction for each trust. The way that Congress amended the bill, there's questions on whether or not administrative expenses that occur and are unique to a trust or an estate, such as fiduciary fees, possible appraisal fees, whether or not those will still be allowed. We're hoping to get guidance from the IRS sooner rather than later. As you'll notice, another thing is that accounting fees and tax prep fees are not subject to 2% for an estate or a trust, but they are for an individual. And as we know, the itemized deductions for an individual have been repealed, but we're not sure, since the estate and trust deductions aren't subject to 2%, whether or not they're going to fall within that area. I'll say for investment fees, those are subjected to 2% for an estate and trust, and would also qualify as an itemized deduction for an individual. So there's a good chance that that deduction will be lost for estates and trusts. A few other things to be on the lookout for, especially within state administration. Prior to the changes in the tax law, in your final year of administration, if you had expenses in excess of income, that excess would pass out on a K-1 to the beneficiaries, and the beneficiary was allowed to take that as part of an itemized deduction subject to the 2% floor. Since itemized deductions at the personal level have been repealed, you lose that actual benefit on the final year return. And this can be a big thing that you want to consider, especially with the timing of deductions. A lot of executors will wait until the final year to take an executor fee. And if you have a large executor fee that's going to wipe out all of the income, there may be no tax benefit for that. And you may want to consider taking an executor fee ratably over the period of administration. Another item to look at is you have the ability to capitalize real estate carrying costs. And you would want to do this in possibly the final year or other years where you have deductions and excessive income. And that way when the property is actually disposed of, you'll receive some tax benefit there, where if you were not to capitalize those costs, they would be lost. A few other changes or items to note is the 199A 20% deduction for qualified business income does apply for trusts and estates. We'll have some examples on how that works later in the presentation and talk about some of those limitations. Another area is in electing small business trust, which is a type of trust that can be an S corporation shareholder. They've added the ability for non-resident beneficiaries to be a beneficiary of this ESBT trust. And they've also changed so that any charitable contributions made at the S Corp level that flow down to this trust will be treated under the individual income tax rules and not the trust rules. And this will make a big difference because the trust charitable contribution rule has very strict requirements, one of which is normally that the trust has to specifically allow for charitable contributions. You are not going to see that very often, especially when it's the S Corp itself making the charitable deduction. So this should allow for the trust to receive some tax benefits from charitable contributions made at the S Corp level that previously were not allowed. And Mike's going to go over a few planning opportunities we have now with all these changes that have come into effect.
Thanks, Sam. And by all means, everyone, these are not all that's out there. These are just some that we're kicking around now. The salty slat, bunching up of charitable contributions, using non-grantor irrevocable trust for charitable purposes, things around the 199 cap A deduction, that infamous 20% of your business income can be deducted. Steve's going to talk about several of those, and then the hunting of basis, and that'll make more sense when we go into a little bit about that. Is basically, let me just explain what a SLAT is, a spousal lifetime access trust. It's basically a discretionary trust for a spouse and future generations. They're not new. People use them all the time. But in light of all the talk about, oh, I've got a second home, or I live in a state that has high real estate taxes, what are people doing? What are people talking about doing? This is just one thing I'll throw out there that some folks are looking to do, and I actually have some folks that have already done this. You basically take that piece of real estate and you put it into an LLC, and then you gift some of that LLC interest into a irrevocable trust that preferably is sitused in an asset protection state. There's 17 states out across the nation that have asset protection status statute on their books. So I won't go into, we could do another 2 hours on asset protection strategies, but just follow me with that. And then you also make gifts of not just the LLC interest holding the high property tax real estate, but you make gifts of some portfolio income that kicks off dividends, interest, whatever it might be, into the trust. And the trust is, say, you're going to have beneficiaries of the spouse and potential kids in future generations. So what happens? We'll make the assumption that married couple has one child. Property taxes are $40,000 a year. We know the deduction is limited to 10. So dad creates a trust for mom, and mom creates a trust for dad, and mom or dad creates a trust for the child. They fund it with different types of securities. The trusts are not all identical, but essentially each trust is generating about $10,000 of portfolio income. You start seeing where I'm going with this. A trust is allowed, what we believe is going to be limited to the $10,000 SALT deduction limit as individuals, but it would be offset by the portfolio income that's sitting earned in the trust, so you'd basically have a net zero from a taxable trust scenario. Now, that's a real simple way of laying this out, but for folks that are wanting to have real estate that's going to be in the family for many, many years and generations with this limitation, it still is an idea that people may want to consider. And I'll let Sam go through the charitable gift, a couple ideas we have there.
Thanks, Mike. Just looking at a few possible opportunities for individuals, and this is really going to kick in when maybe you're going to end up having to take the standard deduction, and previously you would have itemized, mostly due to investment fees and other 2% limitations. Let's assume you have $10,000 worth of state and local tax deductions, but no mortgage interest or anything else. Your next $14,000 of charitable contributions will not receive any tax benefit. In order to possibly get a higher tax benefit, you can bunch all of your charitable deductions for, say, the next anywhere from 2 to 6 years into 1 year, and I would recommend possibly using a donor advised fund so that each year, subsequent year, you'll be able to make contributions from the donor advised fund to the charities as you would have normally, but you have the very upfront ability to maximize the charitable contribution. Another possible planning opportunity is to set up a trust, and on funding of the trust, you don't receive an actual charitable contribution. But let's say you want to make $10,000 to $14,000 worth of charitable contributions each year. You could fund this trust with an amount of assets that's going to produce that $10,000 to $14,000 worth of taxable income, and then from the trust you can make a charitable contribution that would wipe out that taxable income. And otherwise that taxable income could be something that you'd be paying on your personal return without having any benefit from the charitable contribution. You can have it set up so that on top of the charities, a spouse or children are also beneficiaries of the trust. So say the tax law changes later and it reverts back, you still have the ability to distribute the excessive funds to beneficiaries other than just charitable ones. This, while not a new provision under the tax reform, I want to remind everybody that under the PATH Act, we did have made permanent where an IRA can make contributions to it directly to a charity without having first to include that income on your personal return and then having any possibility of a 50 or now a 60% AGI limitation. However, one thing to note is you cannot do a qualified charitable distribution to a private foundation or a donor advised fund. All right, Steve's going to give us some examples of how everything impacts kind of overall.
Thanks, Sam. Good afternoon. At first, I'm going to go through 3 examples on how the new Tax Act will have both positive and negative effects on our ultimate tax that we'll pay. Sometimes we'll come out in better shape, sometimes we'll come out in worse shape. The first example is a married couple under the age of 60 with 2 children with qualified business income. Now, I'm going to get into qualified business income in just a couple of minutes under the new Section 199 Cap A rules, but suffice to say that the pass-through income in this example, the $40,872 that's highlighted, is going to be subject to a 20% deduction. You'll also see highlighted in orange the personal exemption disappears, $20,250, so that's no longer a deduction. And taxes paid in excess of $10,000 is no longer deductible, so that's another elimination of a deduction of $6,698. However, in 2018, we do get the 199A deduction of $8,174, and because of the new child tax credit rules, you'll be able to get a child tax credit for $4,000, giving a total reduction in taxes of $3,306. Off to the right, you will see just how the marginal rates compare between 2017 and 2018, the capital gains, all that sort of thing. The next slide is also going to show some flow-through income, and so in this case, we have a married couple with no dependents and qualified business income, and we will see that again the taxes are being limited. The standard deduction is actually going up because in this case the couple was only taking the standard deduction of $12,700, and that goes up to $24,000. And also the AMT tax, because of the increased exemptions, is also being eliminated here. So in this case, we are reducing our taxes by almost $19,000. In the third example, this is couple 3, which is the same as the prior example. We have a lot of self-employment income. We have interest and dividends, and basically what we're seeing here is a large reduction in their taxes being paid by a reduction of almost $64,000, and that would seem to really hurt and really put you in a higher bracket. But what's happening is when you look on the right, where you look at your tax rates, the ordinary income tax goes from $1,073,000 to $1,017,000 just because of the reduction in the brackets, and that's actually saving the taxpayer $56,000. These examples, what they do is they show you why, particularly in the next few months before April 15th, you really need to look at your projected 2018 taxes based on these changes so that you can make realistic estimated payments or withholding during the year. All right, so now I'm going to get into Section 199A. This is an area that's very complex. It's fluid in that there are so many parts of it that are unclear and really need clarification from the IRS, and who knows when that's going to happen. So some of the suggestions or examples we're going to have, we think will work, but we're not completely positive yet. On the big picture, what we're getting is a 20% deduction of combined what they call qualified business income from pass-through entities. Pass-through entities are partnerships, LLCs, S corporations, and it could even be certain trusts. The qualified business income from each entity is limited. So there's all of these different factors that you have to look at. So at first, if you're looking at 20% of your income, then you have to look at 50% of your W-2 wages. If 50% of your W-2 wages is less than the 20% of your income, then you use the lower amount. If it's greater than the 20% of the qualified income, then you just use the 20% of the qualified income. There is also a second limitation which you can use in lieu of the 50% of W-2 wages, and that's 25% of W-2 wages plus 2.5% of the cost of tangible depreciable property. Now that's the property before depreciation, so it's your original cost. And so if you're in a business that has uses a lot of property, we're talking about equipment, all kinds of depreciable property, this may help you in getting a larger deduction. The qualified business income also includes qualified REIT, that's real estate investment trust dividends, and qualified PTP income, which is publicly traded partnership income. A lot of people are now buying into the publicly traded partnerships as an investment. Qualified business income excludes certain service provider income. We'll get into that a little bit more. And there's another limitation. On the individual side, because all of this flows through to your individual return, and that limitation is on your taxable income, and also what qualifies will depend upon your income level. If you're married filing jointly, it's $315,000. If you're below that level, then I'll get into it a little bit more in detail. You're not limited, and for single, it's $157,500. So the key points on this is that qualified business income has to be connected with a trade or business within the U.S. So you can't have a business, even if it's in a pass-through entity in which you're recognizing the income, you can't have that business outside of the United States. It also does not include any investment income unless the investment income is part of your business, and there's no reasonable compensation and guaranteed payments earned by owner. The specified trade or business, which I mentioned just a second ago, these are types of businesses that cannot get the 20% deduction if the individual's income is above the limitations I just mentioned, the $315,000 and the $107,000 limit. These include health, law, consulting, athletics, financial services, brokerage services, investing, trading, investment management. And what it really comes down to is when the principal asset of the company is the skill of one or more of its employees or owners. So it can be consulting businesses, all kinds of different things. Somehow there were two areas that was excluded from the specified trade or businesses. In other words, they do qualify, and that's engineering and architect services. There was obviously a very heavy lobby in this area. Going a little bit more into the phase-out, the taxable income, for if you're married filing jointly, has to be less than $315,000 in order to deduct 20% of the qualified business income and not be limited to wages, and also to be able to get the 20% on these specified trade of businesses, such as being a lawyer, accountant, or a consultant. So if your income is less than $315,000 as a married couple, and you also meet, if you're single, meet the single limitation, then you're in good shape. But once your taxable income gets to be greater than $315,000, but less than $415,000, which is when it's fully phased out, it really gets a lot more complicated because you have to divide the qualified business income into two categories: the regular and the specified trade or business categories, and also the 20% deduction is subject to phase-in of the W-2 limitation. So both of these areas get phased in or out, as it may be, in this earning of taxable income between $315,000 and $415,000. Now, like I said, if the taxable income is greater, then there is no phase out. There is no deduction for specified trade or business. It's fully phased out, and then you are limited to the W-2 limitation. We have a couple examples in the specified trade or business area. The one is the law firm, which is a 20-partner firm with $50 million in gross revenues, and the average income per partner is $500,000. So you're assuming that each partner is above the $415,000 taxable income limitation. Therefore, there is not going to be any 20% deduction. The second one, law firm B, is a 5-person firm with net income of $1 million, and the net income per partner is $200,000. Because they're below the limitation, it's not a specified trade or business, and the 20% can be allowed. So these are really for small law firms, CPA firms, or other service-type firms. You can still get this 20% deduction. So in this, this is an example of how some planning is still very unclear, and we're waiting for some further guidance from the IRS or Treasury. And in this case, the law firm creates a new entity called LF Support Services, and in this LLC, they're putting in all these services that are not strictly law services. They're receptionists and secretarial, IT support, file retention, marketing, whatever else you can think of. And they will be treating it as a separate firm from the law firm, and hopefully not be considered a specified trade or business. In this example, the LF Support Services income is $6 million, and law firm A net income is $4 million. So maybe the support services firm can get the 20% deduction up to $1.2 million. The $1.2 million is 20% of $6 million. And so one of the possibilities, therefore, we can segregate trade or businesses from the core firm. This isn't just with a law firm. This can be with any service business. Basis hunting. Mike, I'm continuing with this.
Yeah, I'll close with the basis hunting. It was a sort of a term of art, but basically what we're dealing with here from a strategy standpoint is with the new exemption that I think Sam's going to cover with us next, the estate exemption going up and the lifetime exclusion going up almost double to $11,180,000. Folks that were in between the $5 million or right at the $5 million of having a taxable estate or making a taxable gift are now saying that I've got all this extra room. Well, upstream gifts means that there's a potential that, say, a son or a daughter has a highly appreciated assets that they may very well want to gift upstream to a older generation and in order to get a potential step up in basis at their death of those assets. With regard to new trust, we would strongly encourage that if we've got existing trust or new trust out there, that they need to be drafted in such a way that gives the potential for estate inclusion on that asset. Because normally in prior years, we've always thought about when you establish a trust with X number of assets in order to remove that future appreciation from ever being in anybody's estate. That's still a very viable planning option. But let's just say that at some point down the road that one of the beneficiaries, we're not in an estate situation, but we've got highly appreciated assets in that trust. There may be mechanisms that we put in the trust document or the agreement that allows for estate inclusion of that beneficiary to capitalize on that new step up in basis of those assets. And the exact same strategy goes into place with existing family trusts that are out there. With that, I think Sam's going to go ahead and talk to us about some of the items affecting the estate gift and generation skipping taxes.
Thanks, Mike. As Mike mentioned, the tax reform has doubled the estate tax exclusion amount. The estate tax exclusion amount is unified with your gift tax exclusion, meaning that you can give away during your lifetime or at death up to the exclusion amount. It's now been doubled to $10 million, which, when indexed for inflation for 2018, is $11.18 million. With portability, if you have a surviving spouse, this means that you could effectively give away up to $22 million between the two of you. And the 40% tax rate remains unchanged. I know the House plan originally had talked about lowering that, but that did not go through. Another good win for everyone is that we did keep the basis adjustment to the fair market value at the date of death. There were a lot of people worried that this may have been taken out in order to recover some of the costs in the other parts of the tax reform. One thing to actually be aware of, though, is that as of December 31st, 2025, the doubling of the exemption amount is set to revert back to the $5 million amount that's indexed for inflation. So there is opportunity here to make gifts with this increased exclusion amount in order to prevent losing it later on. Just a little overview of gifting in general. The annual exclusion for present interest gifts changed from $14,000 to $15,000 for 2018. This means we also have the ability to do the 5-year front loading of the 529 plan. This will allow you to do $75,000 or $150,000 if you're married and elect to gift split. This can be very helpful if you have possibly young children or grandchildren and want to give them as much time as possible for the assets to appreciate and then come out tax-free. Medical and educational expenses continue to be excluded from gift taxation. Now, in order to qualify for this exclusion, you have to make the payments directly to the medical provider or the educational institution. This can be great for helping pay for a grandchild's possibly braces or helping pay for tuition. With the increased exemption amount, a lot of people may wonder, is estate planning still relevant now that they're not having to worry about paying estate tax? I would say that it's still very relevant, and there's a lot of items out there that should be considered on top of the tax. Asset protection from either yourself or possibly protecting assets that will later go on to your children. For yourself, you have possible divorce lawsuits and those types of issues that will pop up. That can also be a big thing for your children. Say, do you want your children to have the money outright after you've passed away? You may want to do that and you trust them, but you need to think about what if the child gets divorced and the other spouse ends up taking half of his inheritance or their inheritance. This could be prevented by use of trusts and other opportunities. You also possibly want to control how the assets are distributed. If your child maybe you're worried that they may spend all the money too quickly or have a drug and alcohol issues that you want to help protect against. Another item to keep a lookout for is for special needs children and those with disabilities. There's lots of planning opportunities there to ensure that they're able to receive the maximum government benefit but still have additional funds available to supplement those benefits. And I'm going to pass this back to Steve, and he's going to give us a few other strategies that are still relevant.
Okay. State planning with a new exclusion. I mean, this opens up a whole new world for a lot of people because if you're married and you have an additional $11 million or so of exclusion to use, that can be multiplied many, many times using debt, like sales to grantor trust, or sales to non-grantor trust. There are a bunch of things listed here. Spousal lifetime access trust that Mike was talking about before, and the use of charitable trusts such as charity remainder trust, charitable lead trust, and also the sale of family limited partnership interests to trusts using installment sales. A lot of different techniques that have been around that can be utilized again to transfer many times the amount of the additional exclusion that we now have. Life insurance trust is another area to fund the life insurance trust and just making annual exclusion gifts. There are other types of things to do with regards to generation skipping transfer. It gives us the ability to form trusts and to transfer additional assets into these trusts that will be estate tax exempt forever. Again, Sam was talking about how the additional exemption is supposed to term out, I guess, around 2025. So the thinking is to take advantage of these increased exemptions now, because we really don't know if they're going to be around in a few years. Well, what's new I can talk a little bit about what's new for the new law, and going back to the Section 199A that I was talking about before, there are a lot of different planning techniques that are coming out of this that we think are going to work, but we're not sure. For example, if you have a partnership, and this happens quite a bit, where one of the partners is doing a lot of the work in the partnership, and the other partners are more of a passive type of partners, the working partner may get a guaranteed payment for what he's doing. Now, that guaranteed payment reduces the income of the partnership, which does not qualify as W-2 wages. Therefore, the 199 20% deduction is going to go down because your partnership income is going down. One way of possibly increasing the deduction is to restructure the guaranteed payment, and this would require amending the partnership or LLC agreement. So restructuring the guaranteed payment to a priority allocation of profits, so that one person would, let's say, if he was getting a $100,000 guaranteed payment, he would now get the first $100,000 of profits from the partnership. Now, this does not count as a deduction, so the overall Section 199 deduction will be higher than when using a guaranteed payment. So this is just one example of many of the things that can be done, and we're certainly here to help anybody with that. So I will turn that over now to whoever it is. Mike?
Thanks, Steve. Just want to warn everybody, as it seems like every day that goes by, we read some new material, or as we learn more about what the new law, what we think it means, we're coming up with new ideas. I would encourage everybody to, here's our email address. We're going to have several more of these as the year progresses. What I have been told by some of the folks near and dear in the Treasury is that guidance on the new law probably will not start coming out until late summer. They're dealing with a lot of foreign new law provisions and forms and things that were quite extensive in that area of the tax system. So this has not got big priority right now. So if you've got any planning ideas or specifics of your own situation, please do not hesitate to reach out to one of us. We're glad to help. We may not be able to give you a definitive answer, but we can definitely run some scenarios. While we have a lot of proprietary software that we're using to do a lot of these calculations. So, and we do hope that the session here has been helpful, and please, again, as I said, don't hesitate to reach out to any of us.
All right, thanks, Mike. Thanks for all our speakers. And just so that you know, we have 2 additional webinars coming up. One next week will be on choice of entity. Do we want to remain a pass-through, or should we switch to a C Corp? Myself and Michael Elliott will be presenting that. And then the following Tuesday, it will be on state and local by Kathy Stanton and Monica Tillett with our state and local group about some of the ramifications about tax reform behind that. Thank you for attending, and have a